What's going on, YouTube family? Welcome back to another trading video for this week. I'm not sure when this video is going to come out, but I'm trying to get these videos out as quickly as possible. A lot of you guys have already seen my first videos. I hope you guys have been enjoying those videos. Um, Being that it's November 16 as I'm recording this video, I really don't know what type of feedback I've gotten from those videos, but all of that with time, I'll find out and I'll know what you guys want to see more of and what you guys want me to break down. So, last breakdown video, I broke down for you guys my strategy. For those of you guys who did tune into that video, remember I was talking about my strategy being impulse, correction, continuation. It's pretty much just simple market structure. I pretty much went over my strategy in the first video. So if you haven't seen that video, if this is your first time on the channel, feel free to just go check that video out before watching this one, because I'm going to pretty much make this into a series, like a trade-in course for YouTube, so that you guys can understand each and everything video by video and in order. So today's video is pretty much going to be, I'm going to be showing you guys how I enter my trades. Yeah, I'm basically just going to break down like entries. Like I'm going to show you guys some entry work in today's video. So I just kind of want to touch on a few things that I was speaking about in last video. So if you guys remember last video, I was telling you guys every time in an uptrend, price makes a new high, we have to correct. Price has to correct to make higher highs or new highs, right? Same thing in a downtrend. When price makes a low, it has to correct to make a lower high to make newer lows. So one thing I did want to go over too with you guys that I kind of forgot in that video is let's say in the uptrend, right? Because it's more easier for your brain. Let's make it a little tricky. Let's do something like that. So as you guys can see here, right, we're in an uptrend right here. One thing that I should have touched on in the previous video is most of you guys may be like, oh, so whenever price is trending, how do we know when the trend is over? And it's very simple. To know when the trend is over, hold up. Let me copy when it is. So you guys know I basically mark out 4-hour swing highs and swing lows. So that would be a swing high. Sorry guys, I'm a perfectionist, so like everything on my screen kind of has to be perfect. But you guys will get the point. So basically on the 4-hour chart, because I rock with the 4-hour chart heavy. I use the 1 hour sometimes, but very rarely. Like I only use the 1 hour if I want to see like more detail in structure or more detail from what price is showing me. That's the only time I really use the 1 hour like that. Same thing with the 30-minute. Like sometimes they come in handy, but that's why some people might say like you don't just trade one time frame, because sometimes you kind of have to switch, right? Sometimes your entry might be on a different time frame. So to answer the question of how would I know when the uptrend is finished? So that's very simple. So you would know the uptrend is finished, right? Price has been making swing highs, swing lows, swing highs, swing lows, swing highs, swing low, swing highs, swing low, and then it made another swing low. You would know you would know the uptrend is finished once price takes out this swing low. So the most recent swing low in an uptrend, you would know the uptrend is finished once price takes out the most recent swing low. So it would go something like this. Price takes out the swing low. And what I find is that sometimes the market, let's say it creates new structure, right? So let's say the market switches from bullish to bearish. Sometimes um what would happen is sometimes price may start to consolidate, right? Sometimes price would start to consolidate. Or dang, what the heck? All right, let me go back. Yeah, so what may happen sometimes is price may start to consolidate, or what in a good scenario, in a perfect scenario, what we would want to see is price take out the recent swing low, which is right there, and then make new structure, right? To tell us and to confirm to us that the market is switching from bullish to bearish, we would first have to break this lower high. I mean this higher low, and then make a low, then a lower high, and then boom, that would start a downtrend. So it's pretty self-explanatory. It's pretty simple when it comes to market structure and how to know a trend is done. You basically just wait for a higher low in a bullish market to get taken out, and you basically just wait for a lower high in a bearish market to get taken out to know that the trend is wants to reverse. So that was something I wanted to add inside the video. I might leave this. No, actually, let me delete that. Yeah, that was something I wanted to add in the previous video for you guys. A market never just is always going to be bullish 24/7. It's never just going to go up all the time. Like sometimes the market is going to hit or reach the highest point and then it's going to cool down, and then maybe it might start consolidating or it might go into the other direction. So I want to get some real chart, give you guys some real chart examples on how I find my entries, how I go about finding my entries. And I'm gonna use Euro NZD because Euro NZD, I've been making good money trading Euro NZD. Like Euro NZD is such a random pair. Like it's such a random pair that I never thought I would actually be trading. So like you guys know my strategy by now. I basically trade an impulsive move. I wait for the correction, and then I get in once the correction is finished to make new highs in a bullish market, right? So I'll show you guys an example, um, a clear cut example of my strategy, right? Um, I want to show you guys something that's a bit more simple because not all entries are the same, and that's why I always preach like um the markets is very situational. Like it's never like a the market is never like 100% predictable because sometimes the market can literally do whatever it chooses to do in a specific moment. So you never want to say, oh, price is going to go here and then it's going to do that and then it's going to do that. Like you never want to be that type of trader. You always want to react. So pretty much um I'm going to start from scratch. Let me see how far I am. So I'm 9 minutes in. All right, bet. So right here, let me go ahead and delete this. So right here, right, we can see price made an impulsive move up. We broke previous highs, made that impulse up. So this is the new high right here. But once price makes that impulsive move up, and based on my confirmations and what I'm looking for specifically, sometimes I can time when a correction is about to begin. That's why I have my RSI up here. I also use the Fibonacci as well. but I'm gonna be breaking that down in another video. Today, I just want to show you guys like the entry and how I'm able to get in a trade. So let's say the market gave us an impulsive move up, and you figured out that it's ready to correct. So what I normally do is, in theory, I also use the fair value gap. I know a lot of you guys may be against fair value gaps, like, oh, why do you use fair value gaps? I thought all you needed was market structure. And what I want to preach in this video is that although market structure is king, if something helps your trading in a way that only you can understand, if something enhances how you trade and it's been showing you good results, why are you going to stop doing that thing? Why are you going to stop doing that thing? Because what works for me isn't going to work for you. And that's one thing I've learned in life, and especially in this trading space. Like, a lot of people might judge you for using indicators, but if an indicator is paying your bills every month, if an indicator is making you money, why would you stop using indicators because someone is like, oh, why are you using indicators? Like, I'm going to use indicators if it makes my trading easier, if that makes sense. I use fair value gaps to help me judge where the correction is going to finish. And what do I mean by that? So, pretty much whenever price gives us the impulse, you notice a series of fair value gaps or imbalances that gets left behind, right? Some of them are small and faint like that, like this. Some of them are going to be a little more spacious like that. But you notice a series of fair value gaps once price give us that impulsive move up, right? So what I do is, when price starts to correct, I wait to see which fair value gap, and you can treat these fair value gaps as support for a bullish market and resistance for a bearish market. So what I do is, what I do is I see which fair value gap is going to give price, or I see which fair value gap price is going to have a reaction off of. So as you can see, price is clearly ready to correct, right? We were overbought on the RSI. Price started giving bearish divergence, right? And we crossed the EMA. So that's already a couple confluences as to why price is about to correct, right? So I know price is about to correct. We got this fair value gap, this fair value gap, this fair value gap, and this fair value gap, right? So I'm not really too concerned about these. And I'm not saying that price can't come down to these fair value gaps. It definitely could. But I'm only focused on like these main ones that are more recent. So if I speed this up a bit, you'll notice that price, just look at what price did. So we actually got to this fair value gap, and price actually gave us a reaction. You see, like, you could consider this a doji, right? You can consider this a doji candlestick formation, but I'll explain something that's very key. You know, matter of fact, let me explain it right now. So we see price correct to this fair value gap right here, right? How I normally enter is I'll go down to the 5 minute, right? I'll go down to the 5 minute. And on the 5 minute, this is what's happening on the 5 minute. So a lot of the times, and I don't want anyone thinking my strategy is bulletproof and I'm always winning trades. Like, sometimes you're going to be wrong, and that's just a part of the game. But what is being shown on the 4 hour is basically this on the 5 minute. So what I normally look for, actually, let me go to the 4 hour real quick. So what I look for is I look for the first tap into the fair value gap. So the first candle that hits the fair value gap, I'm automatically on guard, and I'm watching this trade like a hawk, because it's like, okay, price got to a fair value gap. Let's see now on the 5 minute time frame. Let's see if buyers step in at this level, And a lot of the times people think, and this is what I was saying in the first video, sometimes the correction may be short. Sometimes price may come down to this level to retest the level it just broke. Sometimes it won't do that. So that's why I feel like fair value gaps help me in a sense, because they kind of help me target where price is going to finish the correction at, if that makes sense. So in this scenario, price, this bearish candle got to this fair value gap. In your mind, even if the trade doesn't play out how you want it to, in your mind, you should now be like, okay, price just got here. Let's see if buyers step in at this level. So you would go down. What I would do is I would go down to the 5 minute, and then I have this indicator. It's called market multi-time frame breakup structure and market structure shift. So what I do is in a bullish scenario at a higher time frame fair value gap, I want to see buyers step in at that fair value gap. So what I do is I wait I wait for a market structure shift signifying that okay, buyers are stepping in. So no buyers yet, no buyers yet. Boom. We got our first market structure shift on the 5 minute. So I don't normally, and I've back tested this numerous times, and I find that when you wait for a break of structure or even multiple break of structures, that adds more confluence, because just seeing a market structure shift sometimes isn't enough. So what I tend to do is I wait for a break of structure. But like I said, my strategy isn't bulletproof. It's not a 100% win rate, but I'm gonna break all of that down. So we see we got a market structure shift right there, and we got a break of structure. So what I normally do, the way I find my entries is I set a pending order. I set a pending order at the swing high of this break of structure. So even though we would have lost this trade, I'm just showing you guys like what I would have done in a real market scenario, whether it resulted in a loss or a win. So I would have set a pending order at the swing high of that break of structure. Then I would set my stop loss below there, and my stop loss would be pretty big, because I'm targeting like pretty high levels. Like my risk to rewards are about 1 to 3, 1 to 4, 1 to 5 sometimes. So I don't mind giving my stop loss some breathing room. So what I would have done is um, I would have done this literally, stop loss below these lows there, and then wait for price to trigger me in. So if we go back to the 4 hour, right, we would have been in profit for a little bit, like we see here. Price would have brought us in profit. Then look what happened though. I'm going to show you guys that my strategy isn't bulletproof. And this is what a lot of people fail to show you guys. So I'm going to show you guys that my strategy isn't bulletproof, but I'm going to also show you that it does work. So boom, we would have gotten massively ripped right here. We would have gotten ripped. But essentially, the point I'm trying to show you guys is that price reacts to these fair value gaps, because even though this fair value gap that was here, you guys saw that there was a fair value gap here, although it never held, price did get a reaction, but it still stopped us out. And that's what I mean by you can still do everything right in a trade and still lose. Right. Not because you do everything right means you're going to win every trade. Like you can still lose. You can still do everything right, follow your rules, and still lose a trade. So that was a perfect example of that. But I also want to show you that my strategy does work, and price does react off of these fair value gaps. So if you guys can't see, I'm going to delete this real quick. There is also another fair value gap right here. Keep in mind that price is still correcting. So although this fair value gap never held, it came down to retest these highs. And there was a fair value gap right here as well. So it actually lined up perfectly. So if we take what I said into consideration of if we take what I said into consideration of I go down to the 5-minute chart, as soon as a candle touches a fair value gap. So in this scenario, I would have went down to the 5-minute, right? We already had a market structure shift and breaker structure. So I would have entered at the swing high of this. I would have entered at the swing high of that breaker structure, and I would have put my stop loss somewhere there below. And some of you guys are probably like, why are you using such a deep stop loss? But my my take profit levels are also very high. Like I'm a swing trader. So yes, I'm using these big stop losses, but my take profits are also very high. So I'm aiming for like 1 to 4s, 1 to 5s sometimes. So I would have entered a pendant order just off of this shift in structure on the 5-minute. And if we go to the 4 hour, all right, my TP would have probably been at the next level right there. So this is a 1 to 4, 359 pips. So although my stop loss has a lot of breathing room, this is still a good risk to reward. And that's all that matters at the end of the day. Like it's better safe than sorry. So not only did the lower time frame show us that buyers are stepping in, but now we're oversold on the RSI. As you can see, we're oversold on the RSI. So that's already two confluences. And another confluence is that, this candle right here left a wick at this level. So it shows me that sellers don't want to go or push price or couldn't push price any lower. So that gave me enough confluence to enter for the buy, and we let it play out. And you guys see that we actually went crazy with this trade. And this was a trade that I actually took in like real time, but I thought structure was going to shift because yeah, I remember this night vividly. There was like news on the NZD, right? New Zealand had a news, or maybe it was Europe, I don't know. But yeah, I looked at my phone this one night and this one candle, because I remember at first I had set my TP somewhere here. And then I was like, you know what? Let me just aim for the highs. And then price actually went here. So I could have made money off rip from this candle alone. But I thought buyers was going to keep pushing us up. But once price made this lower high, I was like, nah, this thing is about to go bearish. But that's the mistake. That's the mistake. And another thing I want to explain, like I was explaining earlier about structure, is as long as if you're in an uptrend market, right, a bullish market, as long as price doesn't take out the higher low, why are you looking for sales? Right? This is what I was saying to myself that time. Why are you looking for sales if higher lows are still untouched? So I actually I was in the trade in the beginning, and then because I thought it was gonna switch to a bearish market, I had gotten out. So I literally left this trade like kind of empty handed, you know what I'm saying? Because I saw price coming down and I was like, you know what? It's about to go bearish. Let me get out. So I actually never maximized this trade, but it's all right because I've been killing on Euro NZD. Yeah, I've been killing on Euro NZD. And I think I want to show you guys another setup too, which was right here. But as you guys can see, like this is textbook of what I mean by like just trusting the process. And like my TP would have got hit, and this is a 1 to 4. And as price went up, you could have moved your target into profit. That's a risk-free trade at that point. 359 pips in the bag. So that's pretty much how I find my entries. So I use 4 hour structure, but when price corrects at these fair value gaps, I then go down to a lower time frame to see if buyers step in. So if we're bullish on the 4 hour, at any given fair value gap, I want to see buyers stepping in. Sometimes, like you've seen, a fair value gap will not always hold. That's why it's very important to use proper risk management and don't overtrade. It's best to just use proper risk management. Best to use proper risk management so that even if you do take a L for thinking that price is gonna go up, you didn't lose much, right? Because if you go all in on one trade, trusting the fair value gap, trusting that, oh, because price is here and the lower time frame is doing this, it has to go up. Like, you don't want to over risk, because even in this scenario, I took a L right here, price came back down here, I seen we got a reaction, then I could have easily got back in, because it's like, okay, if this fair value gap never held, this higher low is all the way down here. We never took out any higher low. So for me to think that this is going bearish, like, that's kind of far fetched. So I knew if this didn't hold, if this fair value gap didn't hold, I knew it had to be this one, especially since we're retesting the highs that we previously broke. So it was just, putting everything together and just making it work. So yeah, that was pretty much that trade. Um Another, and yeah, this trade right here was just another example of what I mean by not all fair value gaps are gonna hold. Sometimes, sometimes they could fail. And I want to tell you guys that off rip, that my strategy once again is not bulletproof. My strategy will take L's some days. And that just comes with the game. But you guys see, like right here, we just caught a 1 to 4, right? And right here, um, so this candle alone, this massive blue candle right here had a fair value gap. But let me actually put it in replay mode real quick. So you guys can see this massive candle right here had a fair value gap. And I thought, just like how we just thought over here that this fair value gap was going to hold and it didn't hold, right? Same thing happened here. So price came down, and this was my original entry right here. This was my original entry. So I'm assuming I seen buyers stepping in on the lower time frame. So I got in right here because I'm thinking, okay, like, we just got this wick right here. So sellers can't push this down any lower. We're at the fair value gaps. The 5 minute is telling me like, okay, buyers are stepping in, and we're low key getting a crossover on the RSI. So I'm like, all right, let me enter. And then boom, what do you know? Price opened with a gap right here. This massive blue candle, price opened with a gap and stopped me out. So that was this trade. I ended up losing this trade. But if you notice, price closed under this fair value gap. So basically, this fair value gap was invalidated once price broke below it. But as I said before, as long as price never took out the previous higher low, you're still bullish. Like, you should not be looking to sell because this fair value gap got invalidated. So this trade, I was actually able to catch it, and after actually, yeah. So I had this yellow dot right here. So we see now that price gave us this doji, this long doji, signifying that sellers can't push price down any lower. And then, yeah, I had entered. Let me find my entry. Maybe I might put my entry on the screen. Yeah, I'm gonna just put my entry on the screen. But it probably looked something like this. I must have entered like right there, stop loss below there. And yeah, I literally targeted these highs right there for a 1 to 5, 466 pips. Like, and look how it worked out. It's like it's like D Wade throwing Bron the alley oop. Like it just did its thing. You know what I'm saying? Like that's all you're pretty much doing, you guys. Like you're literally just following structure. Price gives you that impulse. You wait for the correction into a fair value gap. Sometimes the fair value gap might not hold. That's okay. You wait for the next fair value gap to get tapped, and 9 times out of 10 that will be the fair value gap that gives you the push to aim for new highs. And if it doesn't give you that push, then more than likely the trend is probably fading away. So that's pretty much my entries for you guys. That's how I enter my trades. That's how I find my entries. I basically use higher time frame structure and what the higher time frame is doing, and then I scale down to a 5 minute. Find those early, precise entry signals that buyers or sellers are stepping in, and I get in. And it's that simple. And that's how I'm able to catch these massive like risk to rewards, right? So make sure you rewatch this video from the beginning so that it can make sense. Thank you guys for tuning in tonight. I know this video was a bit long, but expect longer videos because I really have to get into detail so that you guys like truly understand like how my system works as a whole. So, be prepared for the long videos. But thank you guys for tuning in, man. Stay tuned for more videos. The next video I have coming up is going to be on my take profit levels. So I'm going to be breaking down the Fibonacci with you guys. And yeah, just stay tuned for that video. Shout out to you guys for tuning in. And yeah, I'll catch you guys in the next one. I'm out.